Hey, good morning. I hope everybody's doing well on a Saturday morning. It's nice and chilly here in Maryland where I'm at. I think it was 13 degrees when I was driving in. Hopefully you're in an area that's much warmer. But yeah, so today we're going to have an interesting chat. And I do apologize. Usually these are the first and third Saturdays. Last Saturday, I had training for our tax preparation office. So we had our tax preparers in and everything like that. So I just couldn't pull off the presentation and that. So I kind of bumped it a week. And it's kind of good that I did. This week was a horrible week in the markets, both stock and bond, real estate, commodities, pretty much everything. So we're getting to a point where, is this a turning point for the markets? Are we finally going to see some sort of real correction in a very overvalued market? I mean, nobody knows, but we're going to talk about that a little bit, just go through sort of a thesis. And I'm also going to talk about kind of what I'm doing with client portfolios, because we are sort of hitting these points that typically I will sell and go to bonds or cash or something safe. And so we'll talk about a lot of those things. So let's go ahead. We'll just sort of jump right into the presentation. I'll get into this and show you sort of what my thoughts are and try to answer it, because I'm getting lots of questions. Is this it? Is this the downturn that everybody's sort of been worried about? And what we're going to talk about here is just some of the big things, valuations of the markets. I've been talking about that for a while. Kind of how we have some sort of bifurcated markets. We've talked about this as well for a while, and we'll readdress it. We'll look at price action of the markets, what's going on, what's it tell us about what might happen based on the past. We'll look at bonds a little bit. Specifically, we're going to look at what we call the yield curve, and I'll explain that. We're going to look at what corporate executives are doing in these corporations. So you want to kind of watch corporate executives, because if they're buying, that means they think the price is undervalued. If they're selling, it's just the opposite. And then finally, we'll dig into a little bit of inflation, and we'll wrap up with kind of my thoughts of what I'm looking to do here with client portfolios. But I threw in the old Clubber Lang. I don't know if you remember Rocky III, but where his prediction for the fight, pain. So I don't know if we're only really down about 6% in the markets, and everybody's really worried about it. 6% is really, it's a really normal correction. There's not, that's really not something unusual. In fact, in most years, you have 2 to 3, 5% corrections every single year. So 6% is pretty much right in line with that. And in most years, a 10% correction usually happens. We've been spoiled because of the Fed's liquidity that we haven't had a lot of 10% corrections over the past decade, really. So I think people are just a little nervous. But who knows? Maybe it is finally something that's going to happen here. So the first thing we'll talk about valuations. And I've been saying this for a while, that valuations are now at a point where they're the most expensive in history, even more so than the year 2000. So by many metrics, there's some that still 2000 reigns supreme, but for the most part, it's a very expensive market. Now, valuations tell you nothing about short-term moves. You can have an overvalued market get even more overvalued. It's not unusual to do that. But what valuations tell you, and history bears this out, it gives you an idea of what your future return is going to be. And it's really no different than if you buy a car. If you buy a car and you pay a very expensive, very high price, like right now, I mean, there are used cars selling for what new car prices are. Your your miles per dollar, the total miles you drive and what you pay for it, it's not going to be a very good yield unless comparing it to, say, buying a car during a recession when prices are typically lower and people need cash and they're willing to take a lower price. Same with food, right? You don't want to pay $5 a gallon of milk if you could pay $3. The amount of value you get is determined by the price you pay. So it's the same with stocks. So the higher price you pay for stocks, relative to their earnings, the less your return is going to be going forward. This is what they call the Q ratio. This is something that's looked at a lot by financial folks. And really what this does is it just compares, is it better to buy an existing business or to create one from scratch? That's sort of how I talk about it. So it looks at the underlying value of the assets of companies today. Excuse me, it's real dry up here, so I got a little tickle in the back of my throat. Sorry. So you can see, even relative to the year 2000, based on this, the valuation is extremely high. And then if you look at 2008, it wasn't nearly as high back then, and we had a 50% correction then. This is Warren Buffett's favorite valuation metric. And what it looks at is the total market capitalization of all the stocks that are traded publicly on the U.S. stock exchange relative to the size of our economy or gross domestic product. So you have to remember, our gross domestic product is really dominated by small and mid-sized businesses that are not on the exchanges. Like, I have a small business. I'm clearly not, you can't buy my stock on the New York Stock Exchange or the NASDAQ. So the GDP is made up a lot of small and mid-sized companies. So when the total market cap of the publicly traded companies is exceeding the value of the GDP, you're really getting to a point where they're overvalued. So this chart, if you look on the left axis, what it does here, it shows you market cap compared to the GDP. So if you come, let's look at, say, to give you an idea, here in 1959, the market cap, the GDP was 1.12. So it was just over a hair over 1 times the GDP. And then if you go into, in the 70s and 80s, you got under 1 market cap to GDP. Okay. Right now, we're at 2.5. So the value of publicly traded stocks is 2.5 times greater than the size of our economy. And to put it in perspective, at the peak of the .com, we were at 1.95. And in the financial crisis, it was 1.4. So we have a very expensive market there. And then even if you compare it to price to sales, now earnings is something that can always sort of be manipulated. If you get a good CFO, that CFO is going to be able to, use goodwill, amortization schedules, depreciation schedules. There's a lot of things that they can do to make the earnings look better, but you really can't modify sales. Sales are sales. It's gross revenue coming in. So if you look at that here again, price of the stock market relative to annual sales has reached an all-time peak, far exceeding the .com bubble and the financial crisis of 2008. So here again, doesn't mean it's going to crash right now, doesn't mean anything on the short term, but it does give you an idea for longer term valuations. And, we look at the peak of 1999, the biggest bubble in the U.S. stock market history until today. Let's compare what the underlying economics looked like back then, where we saw the NASDAQ crash 82% and the S&P drop 50%. And let's compare it to today. So the growth rate of the GDP, or the size of the economy, much better in 99. Earnings per share growth, better in 99. Real earnings yield, back then, way better than today. Government debt relative to GDP, far better. Same with private debt. Productivity. So productivity is what really drives the economy. The more productive you can be in your job, the more output you're going to have. Wow, big difference there between 99 and today. Labor force participation rate. So this is the amount of people of working age who are participating in a job of some sort. Here again, we see this in the supply chains and everything like that, and why people are getting $15 at McDonald's for every hour. Labor force is much lower. The population over 65, and that could be one of the reasons labor force participation rate is lower today, is because we have more folks who are, of retirement age. The CPI today, it's actually at 7% today. It was 3.4 then. So much better environment in 99 than it is today. And if you look at the Fed balance sheet, back then it was about $680 billion. Today we're topped over $8.5 trillion. The Fed's fund rate back then was 5.5. Right now we're at rock bottom, we're at 0%. And then the yield on U.S. Treasuries, a 10-year Treasury at that time was 4.7 compared to 1.46 today. So we have two periods of very extremely overvalued stock markets. But, if I was going to say which one would be more justified, I'd say 99. Just looking at these numbers here. Okay, so we have an overvalued market, but we also have a market, a bifurcated market, where really a lot of the return has been driven by just a few names. So the top 10 mega cap companies of the S&P 500 now make up 34% of the index overall. So 500 companies, and 10 of them make up a third. That's not healthy for a market. That's not what you want to see. You want to see all boats rising with the tide, not just a few. This also gives you a little bit of an idea compared to 1999 or 2000 of the five largest stocks. So you can see the five largest stocks back in 2000, Microsoft, Cisco, GE, Exxon, and Intel, made up 18% of the market at that time. Today, it's 8%. The five largest today, Facebook, Amazon, Apple, Microsoft, Google, make up 25%. So again, we had 10 companies that make up a third. 5 of them make up 25%, really now 23%. Again, not healthy. And if things pan out like they typically do, these companies are not going to be able to keep that elevated valuation. And just to show you, again, how we have a bifurcated market here, this was last year. And what it does is it's giving you an idea of what contributed to the market performance. So the black line at the very top is the 10 largest names in the S&P 500. They drove most of the return for the S&P 500. And you can see the S&P 500 in sort of that yellow-orange line. The Russell 2000, which are small company stocks, there. But then the green line at the bottom was non-profitable tech. So a lot of the tech stocks that really don't have much in sales and don't have much in earnings had a ridiculous valuation. They lost money. So the way to read this chart is all the way at the far left, you start at 1, and then you see where things go. So for the non-profitable tech, they went from 1 to 0.8, so that they lost 20% last year. Whereas mega cap started at 1, ended up at 1.3, up 30%. So a lot of the return, a very good year for the market, but it was driven by a very few names. A lot of companies were actually struggling last year, and that's carrying forward right now. Now, these non-profitable tech companies, after the COVID market crash in 2020, they were phenomenal. They were up over 100%, some of them up to 300%. So they're pulling back. And this gives you another look at how yesterday's winners are today's losers. So before we get into what each of these lines are, just look at, basically from March 2020 until March of 21, huge up move, flew up. Things went way up. These are all of sort of the unprofitable or speculative investments. But since then, from March of 2021, we've had a very a downturn for most of these. So what are these? Well, the red one that had the worst performance was a SPAC index. So SPACs are a way for individuals to eventually act like venture capitalists. So, I could go out and create a fund that allows regular folks to invest in startup companies, speculative companies. It was something that sort of just came about the past couple of years. Very, very volatile investments. But in 2020, they did great. Everybody was piling money into these things thinking, hey, I'm just a regular Joe. I've only got a couple $1,000 to invest, but I can invest like a venture capitalist now and take that level of risk. Panned out for a year, but now you can see it's really getting hammered. The blue line is Bitcoin, the Grayscale Bitcoin Trust. Again, huge move up after March of 2020, but now it's pulling back. The orange line is the only one that's sort of holding, and that's Tesla. But from its peak, Tesla's definitely coming back. The green line is what they call momentum long index. So these are just, you're investing in companies that, usually speculative companies that have momentum. Momentum stocks are starting to struggle. They're fading back. The yellow is the unprofitable tech names. And then the gray line is ARK Innovation ETF. So this is Cathie Wood's fund. I don't know if you ever heard of that, but essentially, I say the unprofitable tech names and Cathie Wood's ARK Innovation ETF are about the same because that's what she invests in. Okay. So we've looked at valuations. We've also, kind of looked at how it's a bifurcated market, and there's only a few key names that are holding this market up. What about price movement? What's going on with the markets internally? And what we've been seeing here, especially this past week, is a situation where the market and the bond market are both struggling, and there's been wild moves on a daily basis. So bonds are getting hit right now along with stocks. So this chart just goes back to the year 2000 and just kind of shows you a percentage change in the S&P 500 and change in the 10-year treasury. So big moves in both of them. And you can see the only time we've seen kind of the price action that we saw on 118, and then there's actually been 2 days this week. So this chart is a bit dated by a week. So there's now 3 days in 2022 that match up with the other days from 2000 to 2020. So 2000, we saw this movement once in May as the market first took its turn south. Clearly 08, in October of 08, that's when we were basically in the storm of that downturn. And then two movements in 09. Well, one on 129, we end up having a 30% correction from there. In May of 09, it didn't turn into a big correction at all. But then March of 2020, of course, with COVID, we had a big correction there. So price action on bonds and stocks don't look good right now, and kind of only are matching some other periods where we saw large downturns. Another thing to look at is when the S&P 500 has been up at least 100%, or I'm sorry, 1.5% in a day, and then ends up closing down more than 1%. This chart only goes back to 2009. But you can see the big period where we had a lot of those days was when the market was struggling after COVID. But we had one on the 20th, and then we actually had not quite this big a move yesterday, but darn close. So these are price movements that aren't really confidence builders for folks. This chart looks at the yield curve. So we're going to look at bonds. Now, what's the yield curve? Well, remember, we have different maturities on bonds. You could go right now and you could buy a T-bill, which in 90 days matures. You could buy a 2-year treasury. You could buy a 5-year treasury, a 10-year treasury, out to 30-year treasury. So in a normal environment, if you're buying a bond that matures in 2 years or 5 years, you would think that you would get less interest than if you're buying a 30-year bond, because the amount of risk is less. Over a 5-year period, you may or may not have inflation or something that causes your bonds to lose value, but that risk of higher inflation or an event that causes bonds to lose value is much greater over a 30-year period. There's more risk involved. So a normal yield curve, you see yields start here and go up as maturities lengthen. When we enter recessions, typically what you're going to see is the shorter term bonds have the same yield as longer term bonds, or they're actually reverse it where they're higher than the future. So that's called a yield curve inversion. Now, this chart just sort of shows that anytime this compares the 10-year treasury to the 2-year treasury. So you take the 10-year minus the 2-year, and that's what we're looking at here. Anytime we've seen that valuation get close to zero, so that if you took the yield on the 10-year and subtracted the yield on the 2-year and it gets close to zero, every time we've hit that, that's been pretty much a telltale sign for a recession. We go all the way to the left, that's 1987. We come in here, year 2000, and then we go up to 2008. This was COVID. It reached zero during COVID. Right now, it's actually positive. It's 0.8173, but it's clearly on the descent. So if we get to the point where we're busting down, getting close to zero, we have that yield curve inversion. That's usually not a good sign for the economy. So that's something to keep our eyes on. Could it turn back up? Absolutely, without a doubt. Things can change very quickly. Okay, so that's a quick thing on the yield curve. Now we're going to look at something I've talked about for a while. It's just the amount of rampant speculation that's going on in the markets. So what we have is the fact that the markets haven't had many downturns. We have a lot of people that are adding leverage to their investments. So margin interest is a way for you to essentially increase your amount of investments, even though it's much higher than your initial investment. So for instance, if you put $100,000 into a brokerage account, you can borrow stocks on margin. You could get up to 150% of your original investment. So if you put in 100,000, you can borrow another 50. Now you have a $150,000 portfolio, and you just pay a interest on that $50,000 margin. Now, if the markets are going up, that's fantastic, right? You are basically making money on money you didn't have to start with. But if the market starts to come down, that's very bad, because now you're losing at an accelerated pace, and you're going to get what they call margin call. If you get to a certain point in your portfolio, the brokerage will call you and say, you need to put more cash in, or we're going to liquidate your positions. And this chart shows you that margin interest reached a massive peak, absolutely massive peak relative to the dot-com peak, the great financial crisis peak. I mean, we're talking 25% higher in margin debt. And this doesn't even include the amount of leverage that's being taken in cryptocurrencies. This is just looking at the amount taken on the US stock exchanges. on the crypto markets, I mean, it's really ridiculous how much people are speculating and adding leverage to their portfolio. So you can see that blue line, which is the amount of margin debt. It's starting to come down a little bit, but it's still extremely high. But as things start to come down, as that interest debt starts to fall, usually that's where you kind of see precipitous fall. If you go back to 2000, you can see it fell quickly, because as the markets really started to come down, they had to get rid of their leverage. So it kind of accelerates the downturn. So if we start to see people continue to reduce their margin, you're probably going to see stock prices drop even faster, because you have more people selling. We mentioned real quick corporate executives. They are selling at a record pace. Now, the thing you do have to remember about this is the gross amount of sales from corporate executives is going to be naturally a little bit higher, because the market prices for most stocks are higher. So, if they sold 1,000 shares back in 2010, 1,000 shares today is going to be more sales, because the prices for the most part are up. But you're seeing a very large spike, even relative to 2020, in corporate executive selling. So it kind of just tells you that the insiders don't see quite the value that the markets have been seeing recently. Another one to look at is inflation. How does inflation affect stocks? And it doesn't affect them positively. So this chart goes all the way back to the 60s. And what it says is, if the year-over-year change in the consumer price index, or what we use for inflation, when that breaches 5%, every time it has breached 5%, we've had a recession. So, 74, 1981, year over year, we had in 1991. And then, of course, we didn't see it in 99. It only hit 4%, but it did hit 5% for the great financial crisis. And of course, right now we're at 7%. So the year over year change. Again, it doesn't guarantee anything, but pretty much every time we've seen that, we've had some sort of recession. And remember, when I'm talking about a lot of this, we've got a backdrop of a Federal Reserve who is talking about pulling liquidity out of the markets through two different ways. One, they're going to not buy as many bonds. So their $8.5 billion balance sheet is not going to be going up quite as fast. But they're also going to raise interest rates. In fact, there's talk of, maybe getting up to, 1 to 2% on the Federal Reserve rate. Another way to look at how inflation affects stock prices, this is looking at the price to earnings for the stock market. So a typical stock market in normal times, where you have between 0 and 4% inflation, the average 10-year price to earnings, so that's taking the price to earnings over the past 10 years, averaging that out, the average has been about 20. If it's greater than 4% inflation, that average is 13. If it's greater than 7% inflation, that average is 10. Right now, we're at 40. So even if we were to go back to like a normal price to earnings, you're talking about a 50% decline in markets. If you throw on a high inflation environment, you're talking substantially more. Not saying it's going to happen. I'm just saying, historically, that's what's happened. And outside of 2021, 2022, the highest valuation ever awarded the U.S. market with inflation above 5%, a change in inflation above 5% was 23. So, if we keep this level of inflation, probably the best case scenario is we go from 40 to 23, which is still probably over 40% correction. And I do want to just talk about inflation a little bit more, and just the biggest thing is the Federal Reserve is now probably going to raise rates. A lot of people think, well, maybe they're just jawboning that they're going to raise rates just to kind of keep some speculation down and maybe cap inflation. In the past, the Fed has just let inflation go. They've continued the liquidity, let the markets go because it really didn't turn into cost inflation for the average family. We now have a situation where politicians are feeling the pain. I mean, even 2 days ago, President Biden essentially said he gave the Fed his blessing to stamp out inflation. The only way they can stamp out inflation is by reducing liquidity in the markets, raising rates, stopping purchases. So politicians, when they feel the pain from Americans, politicians only react to pain. If you don't put pressure on politicians, if they're not going to feel pain, they don't do anything. They're not going to help you out. They're not feeling it. So at this point, politicians are like, I'd rather see the market come back. I'd rather see a loss in markets than a continued increase in inflation. Because you have to remember, the vast majority of Americans have less than $1,000 in their bank account. You know, if you're watching this, you probably have stock investments, bond investments, mutual funds, things like that. You've been a saver. So a pullback in the markets is going to have a very negative impact on you. But if you're somebody who doesn't have $1,000 in your bank account and it's costing you substantially more to fill up your gas tank, feed your family, that's real impact. I mean, that's some serious impact. That's going to make you angry. You know, a 30% correction in the stock market and you see your 401ks go down, you're not going to be happy about it, but you may not be calling for blood of the politicians. If all of a sudden you're barely making ends meet and you have to cut all discretionary spending. I mean, you can't go to movies, your vacations, no way, stuff like that. You're just worried about day to day. You're angry. Okay, so I think we have a position where the Fed has got to act to stem this inflation. And I don't know if they're going to do even enough to do that. But we're in a position where I don't think that they're going to pull back this time. I think they're going to let the markets take it on the chin, mainly because of political pressure. Okay, so oil is still the only asset class right now that is up for the year, and that's still doing well. And I'll show you that in a second. But this is just a chart showing, according to Goldman Sachs, which, you know, I don't really trust them, but, you know, they have some smart people there. You know, they're still saying we're looking at oil, the probability of oil going above $90 a barrel at about 30%, and a 20% chance it might go to 100 a barrel still. A lot of this is based on the fact that here in the U.S., the government has slowed the amount of oil exploration that we can do. It's also based on OPEC countries are struggling to meet their goals of oil production. So they're not even producing as much oil as they want. And then you throw in a nice little mixture of what's going on with Russia and Ukraine and some political tensions there. You know, we have a point where, despite the fact that, you know, maybe the markets might start turning south, oil may continue to go up. And there's actually historical precedence for this because that's what happened in 2008. You might remember oil hit 100 a barrel while the markets were struggling. Eventually, once the full-on recession happened, the price of oil came back down. But the price of oil going up is something that essentially accelerated the downturn. Now, this chart basically shows you that oil is doing quite well right now. This is the Select Sector Fund, the Spider Select Sector Fund investing in oil stocks. And there's three lines here. The green line is the 200-day moving average, which I use a lot to determine if we need to reduce equity positions. When a vehicle breaks through this green line, the 200-day moving average, that's when I start to think maybe we need to sell. But there's also a 20-day moving average here and a 50-day moving average. And you can see the current price of XLE is well above all the moving averages. So it's a very bullish sign. Let's look at some other asset classes. Well, here's the Vanguard Total Stock Market ETF. This is not a good sign here. This is basically showing it's blown below the 20 and 50 day, and now it's reached the 200-day moving average and it's breaking that. What does that tell me? Well, it tells me maybe it's time to sell and wait and see what happens. So I'm probably going to be making some moves here next week in the markets. Now, the only thing that's keeping me from doing that, if you go to the bottom of the screen, you'll see something called the RSI, Relative Strength Indicator. Now, with the Relative Strength Indicator, that's the purple thing at the bottom. When you get to the bottom of that chart, the purple chart, it's basically that number is, the chart goes down to 30. When you get to 30, that usually means that the market is oversold, that you could expect a bounce. If you go and look historically when the RSI is low, you can usually see the market actually does turn up. So there is a possibility that just internal dynamics of the market are going to send it back up, at least in the short term. That's why I'm looking to do it next week. I was actually supposed to trade on Friday, but I'm like, the RSI is very low. We might get a little bounce. We'll have to see. Doesn't mean we will, but usually when it hits these levels, even if it's a short-term bounce, a dead cat bounce is what they call it, you get something like that. But based on the moving averages, the stock market is hitting a point where we're really struggling. Same NASDAQ. So tech stocks, same thing. RSI is at a point where you usually get a bounce up. So that could be bullish. But based on the moving averages, we're getting to that point where you need to take some caution. The other thing, I showed this in the past for the NASDAQ, really, and this is a little bit dated. It was the end of 2021. But basically the number of NASDAQ stocks on the exchange above the 200-day moving average has been moving down rapidly. So again, just a few names are holding up the NASDAQ. Your Facebooks, your Microsofts, Amazon, Google, Apple, that kind of thing. So that's not a very good sign long term. Utilities, they're hanging in there well above the 200-day. And this is also kind of a bad sign for the market because utilities tend to do better when the growth side of the stock market doesn't. Utilities are very boring companies, very good dividend paying companies. So when they're doing very well, typically that means the growth stuff isn't. This is another holding that we've got, International High Dividend. So this is what I used when I made my move in September, where we went to the Volatility Index and I reduced our bond exposure and added it to high dividend paying companies. This was our big holding. It's looking good, well above the 200-day, well above the other moving averages. So, and it's got a 4.9% dividend yield. So that's still doing well. This was a value play I did, the equal weighted S&P 500 fund. It's right up against the 200-day moving average. It's nestled right there. So again, really going to watch that. Gold is doing well. Gold has busted through. It's been struggling all of 2021. It was actually down about 4%. It is now moving up. It's above all the moving averages, including the 20, 50, and 200-day. So bullish situation for gold. And to give you an idea, when you have a drawdown in the typical 60% stock, 40% bond, which we're seeing right now because both stocks and bonds are struggling, gold serves as a very good hedge at that point. All of these periods, the blue line is gold. You can see the red is the 60-40 portfolio. Every time the 60-40 portfolio is down substantially, gold is up substantially. So if things hold, if we see the correction, if bonds struggle, stock struggles, so the 60-40 portfolio overall struggles, we'll probably see a good return with gold. And I also believe you've got the backdrop for good return in gold just because last year gold didn't do well. Same with silver. Silver has been way below all the moving averages for the most part for quite a while, had a bad year last year, but it has now breached the 200-day moving average. So it has broken a long-term trend and seems to be moving in the right direction. Okay, so gold, silver looking really good, oil looking good, stocks and bonds, not so much, but we'll see. It could be short term. Again, it's only a 6% pullback in the stock market overall. That's normal. That's healthy, actually. We usually see 2 to 3, 5% drawdowns every year in a normal year, and even 10%. So even if we go down to 10%, that's still a normal correction for any market. So if the underlying market fundamentals are strong and we have a 10% correction, that's completely healthy. It's good for the market. It's kind of like, if you have a small brush fire, you don't have the big forest fires. But there are a lot of things that have me alarmed, valuations, the yield curve, bifurcated markets, a lot of these things kind of tell me, the price movement recently kind of tell me it could be something more. So anyway, I always finish off disclaimers, right? Everybody's got a disclaimer now. Don't be stupid. Don't take this as advice if you're not a client. If you are a client, make sure you talk to me before you do something. Don't be stupid with your money. Also, we'll jump to questions, but I want to remind people, I'm really ramping up my blog, Saving Yourself from Wall Street. Going to put out a lot of information there. So if you can go sign up for the newsletter, that'd be awesome. You're going to get access to all of our information as it comes up. Okay, so I don't see any questions right now. So maybe I just scared everybody to the point where you're just going to go straight to the bar and start drinking. Hopefully I didn't. I'm trying to be honest here and just show you sort of what I see. I follow a lot of people in the financial media, a lot of very smart people. And this is sort of the educational output that they're providing. So I think it's, seriously, I think caution is warranted, especially because I think that the Fed is going to have to do something. They've got to, because the political pressure is there. And if we continue to have 7% inflation, remember, it compounds just like an investment return does. So all of the inflation we've suffered through thus far this year, the prices you've seen at the pump, prices you've seen at the grocery store, if we have another 7% on top of that, I just think this stuff starts to compound. So if you already saw a 7% increase, so something that cost $10 is now, $10.70. Well, if you have another one, now you're talking, it's, $11.20 kind of thing. It really starts to impact people, especially most Americans who don't have more than $1,000 in the bank account. Okay. So we'll get back on a regular schedule. The next presentation will be the first Saturday of February. Please throw some questions my way. I'm happy to answer. That's what I base these things on. Clearly, I've been getting questions on market action that's been going on recently. So appreciate your time. Hope you have a great weekend. Well, I know a lot of people getting ready to watch some football, but have a great weekend, and we'll talk to you all soon.